Hello, everyone, and welcome to the weekly roundup. Today, we will cover tariffs, inflation, and market sentiments. Hello, Ben.
Hi, Eva.
How's it going?
Going pretty good. Pretty good. Nice sunny day. No more snow falling. So that's a good news.
Sunny? Okay, we'll start off with the recent announcement from President Trump on increasing the scope of U.S. tariffs on imports to include automobiles, pharmaceuticals, and semiconductors. What could this potentially mean for Canada being a key exporter?
Well, it's a great question. And I think that as we said at the top just before we got into this conversation, that there's so many things that he's doing every day. It's hard to keep track of what he's putting in place. And I caught a headline this morning talking about lumber again as well, putting the softwood lumber on the list. We're a huge supplier of their building materials for building houses in the US. So, if they decide that they're going to attack everything that we export to them, it's going to be inflationary for him. And it's not going to be good for us either. It'll just slow things down. So, I think it's an interesting thought around what the experiments he's going through right now. And so if you think with an economic mind, you know that tariffs are inflationary, and then you try to think with maybe more of a salesperson type mind like him, where he's suggesting that like these are his negotiating tactics. So we put this in place, but you do this and we do that, and it's a negotiation. And so I think it's probably more of that. I listened to a gentleman this week. Andreas Stenos, who is based out of Europe, and he's kind of talking about the counter tariff movement that's going on, where a lot of the countries are starting to tariff back, and we're having this kind of ebb and flow back and forth, which might actually result in less tariffs around the world. Which is an interesting way to think about it. It's maybe this negotiation type of style that Trump's looking for, and so I think big picture on the surface, to your point, if this happens, then it's going to slow the economy. What is some of the things that he wants to do is he wants a strong economy. So, I think it's probably negotiation tactics, definitely negative short term if they proceed on these tariffs, but ultimately, I think, midterm, we'll say 6 to 12 months out, probably results in easier financial conditions than we have now. But today, yeah, immediate concern, what happened, probably pressure points could result in some upticks in inflation.
Okay. How will this also affect rate direction from the Feds?
Also, a great question and point. And so I think, when you studied economist or economics at school, you would have thought, okay, higher inflation results in higher rates, right? Like that's simple. That's what happens.
Yeah.
And so I think, I've had to unlearn that as we've seen how central banks have reacted to conditions. So, most central banks around the world have a couple of things that they're responsible for. In the US is central bank is unemployment and inflation are kind of their key mandates. So uh, it'll be interesting to see which one trumps which. I think in Canada, what happens is even if we have an uptick in inflation, rates come down and our economy is slowing faster than the US at the present time. So I think we probably see, even if we get a couple of beats on inflation, rates are still going to come down in the Canadian market. In the US, I'm a little bit less certain as to the path, but if you look at what percentage of GDP is consumption based, you could argue if it's 65 to 75%, and depending on what number you look at. So, you need a healthy consumer in the US in order for their GDP to expand. And so rates are where they are right now is restrictive to consumer spending money in the US. So, I think the long answer to that is I think rates come down no matter what. And I think the longer we have this, we'll say tariff fear, tariff talks, the more likelihood rates come down faster. So, but I think it's a moving subject as the rules change every day right now.
Okay. What is the market saying? What has trading sentiments been like this week?
So we've been bouncing up around highs in the U.S. certainly. Nasdaq, S&P have been bouncing around highs. Those the Mag 7 continues to drive those numbers up to that level. We've seen a bit of a correction today. The Dow's down presently 650 points. And so some of that's off of Walmart's numbers today, where they will say guided lower and suggested maybe things are going to be a little bit softer than anticipated. But the markets themselves have been surprisingly resilient. And even some of the areas which we've been talking about, which is China and maybe some of the Asian markets, are off to a good start this year. And so I'd say generally markets have sloughed it off. What's been happening, with the exception of one thing that I think is the most interesting, which is US dollar. And so as we came into this year, and even if we came into 2 weeks ago, I think when we talked about this, right, we saw the Canadian dollar get crushed to 67, 68 cents. That was about 148 on the other side. And now we're 141. So the Canadian dollar has been quite strong versus the US since the tariffs have been announced and retracted and announced and retracted. So US dollar has been generally weaker. And if you look against the major crosses as well, the US dollar has been weaker. So that's suggesting maybe the world isn't as scared as they were 2, 3 weeks ago. So that US dollar weakness really has an impact as for what's going to happen to markets, and particularly international emerging markets. So I'd say that's kind of a long-winded answer to your questions of how the market's digesting this.
Okay. Let's go into the charts.
Okay, perfect. Oh, yep. So we're recording this on February 20th, as usual, on the Thursday. So this is one I know I've put this up on and off over the past couple of years, but I thought really more important to just kind of bring it to the top again, just from thinking about what happens to rates and what happens when bond levels are at the level they're at right now. And if we do see a direction where interest rates start to move lower in the different categories, this is a reminder of just how bonds work in relation to interest rate direction. And so if we look on these, I'd say I'll just point to two of them, which is the US 10-year bond and the Canada 10-year bond. So I think it's important just to think about it from a perspective of what could potentially happen. And so where we think typically of bonds from the interest rate we get. And so if you look at a 10-year US bond right now, it's paying 4.51% right now. And so this is a view, this is where the 10-year bond rate is in the US. And hypothetically, for whatever reason, if that 4.5 dropped down to 3%, which is a 1.5% change right here. So if we saw 4.5 to 3, and so that rate could come down for multiple reasons. Maybe the economy's expanding a little bit quicker than expected, and those rates come down. We see maybe a period where the central bank of the U.S. decides to go out and artificially keep rates down via yield curve control or Operation Twist or quantitative easing, any of these types of environments where the central bank intervened to bring rates down. So you see 4.5 go to 3%, your actual bond would go up 16.5% capital appreciation. So that's how much your holding goes up in that environment. And so part of why this is relevant is because, we went through a period in 2022 where bonds and stocks went down together, but now we're faced back into a different environment where maybe they start to be uncorrelated again, and you get a little bit of protection owning some bonds versus stocks. And so this was an interesting piece. Same would apply in Canada. So Canada's 10-year is 3.2%. If we go from 3.2 to 2.5, and then we get that capital appreciation in your bonds there as well. And then just one quick snapshot just around that 30-year bond. It's so sometimes people want to have a little bit of exposure, some bonds in the 0 to 2 years, and then maybe a small percentage in the longer duration. And so that allows you to have a little bit more balance within your portfolio potentially. And so similar in the US, we're at 4.775% right now. So 4.7 here in this case. And so if that dropped by 1.5%, so if we got to 3.2%, your actual 30-year bond would have a capital appreciation of 30%. And so just when you're thinking of balancing out risk within portfolios, this is a good to toggle that allows you to have a little bit of bond. You don't need to have 50% or 100% in your portfolio in this, but could maybe act as a bit of a counterbalance to some of the riskier holdings that you have in your portfolio. So I thought that was a good one to look at. The other is just around commodities. And so we've had lots of questions just around what's going on with commodities and where we go from here and so on and so forth. Certainly crude oil has been range bound now. And so we still think that that's likely where we're going to be. The technicians certainly would be getting excited about what's going on with the moving averages. Because right now we have the 200-day, or sorry, the 50-day coming up and potentially touching that 200-day. As a technician, when you kind of get the 50-day coming from below, that's a bit of a breakout in oil. So certainly the technicians would be excited about that and watching that. Gold, we've seen move up to new high levels. There hasn't been a cross in moving averages, but the trend continues higher in gold. I'd say multiple reasons as to why. There's been lots of hubbub about lots of institutions moving their physical gold from Europe to the US vaults, and that's kind of put storage costs up. And you've seen this massive move of gold. That's more probably a short-term fix and risk decision from the fact that maybe the US decides they want to get more aggressive with Europe and they don't want to have the gold there, so on and so forth. Copper, we've started to see trend back up. And then the one biggest move, which you probably see along the top line here, is nat gas. I mean, nat gas has been on a tear here, certainly on a month-to-date and year basis. So certainly, let's watch what happens to that. Some of that has to do with seasonality and cold weather, and we certainly know about that if you're up in Ottawa these days. Great chart put out from our team. We have a sustainable team that puts out a view, always interesting research. Certainly I get questions about this on a frequent basis just around oil and gas exposure for the Canadian banks. I thought this was a great chart that shows you the breakdown of who has the most exposure and who has the least exposure to the oil and gas sector. A lot of the banks really have a focus on moving to that net zero type of model. And so as right now you see the discrepancy here with BMO having the least and Scotiabank having the most on the right-hand side. So great chart. If you're interested in the full presentation deck about it, certainly let me know. But great outlook just around how and where the banks have been moving towards from a ESG perspective. And as always, these opinions do not necessarily reflect those of NBF. If you have any questions, certainly speak with your advisor or myself, and I can answer your questions. And everyone's risk tolerance is different. So as always, I appreciate you listening to what we have to say. And I hope you appreciate the charts this week.
Great charts, Ben. What are we looking for? What's next week?
So we are approaching the end of the month here. So we're getting the end of February. We're happy that it's the shortest month of the year because that means winter's almost over.
Right.
Yes, exactly. So lots of economic data still to come out in the US and Canada next week. The US has some decent economic reports coming out next week. Tomorrow we have Michigan sentiment in the US. So we'd be watching that as we come into the end of this month. And as we look towards March, the central banks are meeting first week of March. And so we would start to see what's going to happen there. On our call last week, I think we talked about it was a bit of a coin toss whether Canada's central bank cuts or not. I still think that's the case right now. So let's see. That definitely is a moving target. Really has a lot to do with what Trump's been saying. So I'll be watching that. And then seeing how markets follow through from this point. It's been a bit of a more choppy February than January was. And so we'd be looking at that. I'd say that one piece that I mentioned off the top was US dollar, what's going on with US dollar. And that I think will be a key piece here as the US dollar has sold off in the past couple of weeks. And if that continues and that trend continues, that's a good news for risk assets. And the other piece that comes up every day is what's Doge doing, the Department of Government Efficiency. So they've been laying off people at a breakneck speed. And so, it's interesting as we start to look at what could potentially happen here if the market starts to think about maybe the US can get its deficit down temporarily, then bond yields probably move lower on the back of that. And so I'd be watching those. But, the job firings in the US is moving quite quickly, especially with the government. And we've seen, as we spoke about earlier this week, that housing in the Washington area, housing prices have dropped about 20% since the election. And so, that'll be interesting to see how all these dynamics play out. But rates staying this high for a long period of time in the US isn't good for the consumer. So,
Yeah.
I'd be watching that and keeping a close eye on the US dollar from here.
Great. Thank you, Ben. For our clients, please reach out to me if you have any questions or if you'd like to book a portfolio review meeting with Ben. For everyone, please visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. Thank you for listening. Have a good day. Bye.
Thank you. Take care.